For over a century, the United States carried a badge of honor, AAA, the gold standard of credit ratings. But that badge just cracked. On May 16, 2025, Moody's, the last major credit agency still holding the line, officially downgraded U.S. sovereign credit from AAA to AA1. This wasn't just symbolic. It was systemic. Welcome back to FluxFolio Finance, where we expose the financial forces shaping your future. Today, we're diving into a downgrade that may sound quiet, but carries the weight of an empire in slow retreat. Let's begin with the obvious. Why did Moody's pull the trigger? The reasons, they said, were simple. But the implications? Far from it. America's national debt now exceeds $36 trillion, a number so large, it's hard to wrap your head around. That's about 134% of GDP projected by 2035. Interest payments on that debt are exploding. What once took 9% of federal revenue back in 2021 is projected to consume 30% by 2035. That means almost 1/3 of all U.S. tax income will be used just to pay interest. And there's no credible plan to fix it. But behind those numbers is a deeper signal. Washington has lost the political will to act. Gridlock in Congress. Polarized administrations. Endless fiscal deficits. Moody's isn't just judging numbers, they're judging governance. And in their eyes, America is no longer a safe bet. So, how did the markets react? They flinched. Yields on 30-year Treasury spiked above 5%, signaling a jump in the government's borrowing cost. The Dow Jones dropped over 250 points at the open. The VIX, also known as the Fear Index, surged sharply. It wasn't a crash. But it was a warning. Because when the most powerful nation on earth gets downgraded, the global financial system doesn't just react. It recalculates. To understand the full impact, we need to link this moment to a broader play, one you've heard before if you've been following our Mar-a-Lago Accord series. Trump's administration, in 2025, wasn't just focused on tariffs or trade. It had a larger strategy. A doctrine. Create volatility. Manufacture uncertainty. Then drive capital back into U.S. Treasuries as the safe option. It was a deliberate play to weaponize global fear, so other countries would have no choice but to buy American debt. But now? The final domino has tipped. And Moody's just broke the illusion that Treasuries are still untouchable. Let's pause here and ask the key question. What happens when a downgraded superpower needs to refinance $7.6 trillion in maturing debt this year alone? That's not theoretical. That's 31% of all marketable U.S. debt. And it's due now. If yields keep rising, the cost to refinance becomes crushing. And if confidence erodes, foreign buyers, China, Japan, Europe, may not show up. That's when crisis becomes collapse. And here's the twist. In past episodes, we revealed how hedge funds were piling into basis trades, borrowing short-term money to buy long-term treasuries, hoping to profit from small price gaps. But those trades are heavily leveraged. Now, imagine this, as yields spike from the downgrade, the value of those bonds falls. Hedge funds face margin calls. They start selling. Fast. It becomes a feedback loop. Prices drop. Yields rise. More selling. More panic. What started as a downgrade turns into a liquidity crunch. And you know who's stepping in to backstop this chaos? Not central banks. Not sovereign wealth funds. Tether. Yes, the stablecoin giant, holding over $150 billion in assets, with $118 billion in U.S. Treasuries. Tether, Circle, and other crypto-linked firms are now some of the largest private holders of American debt. The same digital rebels that once vowed to escape fiat money are now its biggest lifeline. This isn't decentralization. This is absorption. The crypto world is underwriting the empire it once aimed to dismantle. But the broader consequence isn't just financial. It's geopolitical. Because America's greatest weapon hasn't been military, it's been the dollar. The global reserve. The asset everyone trusts when things get messy. Now? That halo is dimming. Moody's downgrade signals to global investors, the US might still be dominant, but it's no longer disciplined. And if confidence in treasuries breaks, confidence in the dollar isn't far behind. We could see capital flight. Gold surging. Bitcoin breaking new highs. Foreign central banks pulling away. The Treasury market doesn't just set interest rates. It sets the rhythm for global capital. And that rhythm? Is faltering. Now let's talk personal. What does this mean for you? Mortgage rates may rise. Credit cards will get more expensive. Auto loans may spike. Inflation could return. And your investment portfolio? Could whiplash from volatility. But more importantly, the world is entering a new phase, where debt is no longer free, and trust is no longer infinite. This downgrade isn't just about the US, it's about the end of an era. The end of easy borrowing. The end of automatic belief. The end of the myth that it can't happen here. So what's next? Watch the bond auctions. Watch for foreign participation, Japan, Europe, oil-rich Gulf states. If they start to fade, you'll see yields climb further. And if the Fed is forced to step back in, buying treasuries to suppress yields, we could see a new round of quantitative easing, or worse, monetary regime change. But don't forget, there's always a plan in the shadows. The Mar-a-Lago Accord was never about solving problems. It was about forcing the world's hand. If this downgrade causes just enough panic, it might do exactly what the Accord intended, scare the globe into buying American debt again, not out of trust, but out of necessity. A financial Cold War, priced in basis points. And in that war, what should you do? White check mark emoji, hold cash short term, but don't rely on it forever. White check mark emoji, gold and Bitcoin become more attractive as monetary anchors. White check mark emoji, watch central banks, their bond purchases are the new battlefield. White check mark emoji, be cautious with long duration assets, especially if yields rise fast. White check mark emoji, and most of all, track the bond market like you would a fault line. Because this isn't a recession forecast. It's a credit fracture. Let's close with this. The Moody's downgrade won't crash the economy overnight. But it may be remembered as the moment the world stopped pretending. Stopped pretending the debt didn't matter. Stopped pretending the dollar was eternal. Stopped pretending the US couldn't break. Moody's didn't trigger a crisis. It revealed the one we were already in. Thanks for watching FluxFolio Finance. Like, subscribe, and drop your thoughts below. Will this downgrade cause a debt spiral? Or a new buying opportunity? And remember, the end of belief is the start of awakening. Stay curious. Stay prepared. We'll see you in the next video.